it passed by the slimmest of margins the first time. Now, can they agree with the Senate's um, amendments that they made to the bill? And there's a lot of questioning back and forth on whether or not they can and whether or not they can get this to the president's desk by his requested. He backed off that a little bit this morning, July 4th date. He was saying, I'm not sure if that's possible, but he would still prefer that. I think he would love to sign it on July 4th, but we'll see if the House can get it through at this point in time. You've probably all seen the war of words has restarted again between Elon and the president. I'm not going to quote Elon on his comments, just that when we take a look at the chart of Tesla, I don't think he's doing his stock price any good by having this war of words. Maybe he's just trying to bring back the people that were angry at him for being part of Doge in the first place. Not really sure what his motivations are. Maybe when you have that much money, you don't care. I don't know, but that's the news of the day, and it will be the news of the week. So let's go look at the chart of the S&P. And I brought this back up because in the U.S. market update over the weekend, hopefully everybody had a chance to look at that. There were a couple comments, and there's always Elliott Wave haters that exist in the market. Seen it ever since they started trading Elliott Wave. And my viewpoint has always been that anyone that doesn't like Elliott Wave, either one, has unrealistic expectations because it's not 100% accurate, nothing is, or they don't know enough about it because a lot of people just go through the impulse correction part. They think they can label the charts by hand, all kinds of different scenarios that play out, and it's very complex. I live by the creed that nothing worth having comes easy. And if you put in the hard work and do a good job, you'll get rewarded in the end. Maybe we don't always, but I feel that way. And so I feel like you have to put the time into the education on Elliott Wave. And that's why we've posted so much Elliott Wave education on our website at ewotrader.com. But what I wanted to highlight is basically stuff we featured during that Zig-Zag Masterclass. I think a lot of you attended. We go all the way back to February here at the previous market highs. Apologize, dealing with mad allergies this morning. We had all kinds of rain here, and now the sun's out and everything is blooming. Drive me insane. But here was the downward zigzag following the February high, where we retraced right to the 38.2% level. That gave us the 61.8% extension. And then we moved on down to the 100% extension. That was the second level. And then I call this 2.5 levels of extension on the C wave because I don't often talk about the 138.2% level. It's been my experience that oftentimes when you get to 100% extension, if you're going to extend further on the C wave of the zigzag, you go to 161.8. But keeping in mind that we had already reached the initial extension and a further extension at 100%. So this would equate to going past 161.8%. And so that is a fib level. 138.2 is a fib level. It's in the rotation of Fibonacci percentages that act as support and resistance. And then since then, we've followed Elliott Wave rules to a T, complete with 4 zigzag patterns. The primary one that started off those tariff tantrum lows, as you call them, Zach, in April. And then we moved up in a very complex C wave that had not 1, but 2, but 3. And then we added a 4th zigzag in it. There were 3 zigzags in the C wave, but it ended up being 4 C waves that all converged right here at the February highs, which is where we are. So we're right there. Now we have various extension targets. As you can see, there's a conglomeration of them here based on which zigzag you're looking at. And oh, by the way, we threw in a triangle here just to add a little more complexity to the zigzag patterns. And you know that we either have mono waves or complex waves. Well, we have most certainly had very complex moves to the upside. But every one of these zigzags, all of them played out to a T. I don't know how anybody could have watched the markets since the February highs, even forget anything before that, uh, but watch the market since the February highs and not thought that Elliott Wave works or zigzags work. And the Elliott Wave rules state that all five-wave impulse patterns start with a zigzag. And then now we've labeled this as a 1, 2, 3. It's been 100% spot on, hasn't missed a beat since February on Elliott Wave and these zigzag patterns. So where do we go from here? We're starting to get a little bit of separation here from the 10 and the 50-day moving averages. Not too much, but you always pay attention to that. It's the same thing as the rule of no security in any time frame gets too far from the 10-day moving average. You watch that separation between the 10 and the 50s as well. It's still okay, just worth watching. The question becomes, do we sit here at these February highs, which is where all these C waves extensions said we were going? You can see 1, 2, 3, 4. They're all right there at the same spot. But a new thing has come in. The AI signals from the Hub software that you may or may not be aware of. And I think everybody by now here has gone to hub.com and gotten a free copy of this software, complete with the Elliott Wave, or you can subscribe to the AI signals if you want. But we have a recent posting on the SPY. Now, it's only a 62% number. We like to look for sending out alerts based on these AI signals at 75 or above. So it's not quite in that area. It's a little more than a toss of the coin, according to the AI, if we continue higher in this movement here towards this 650 level, or perhaps we start the wave four sooner. You could make a case for either one because, again, we've had all of these conglomerate extension levels here between where we are right now and that potential AI target. But once again, it's a 62% score, which is a little lower than we would actually send out an alert on. So we watch and see where do we go from here. You stay with what's working, and then you keep an eye on things that could be interesting. And that's where I think we are. There's the CCI and the DMI to take a look at. And if you look at this formation of the DMI, where the rubber meets the road, the line in the sand, pick your favorite cliche, that's where we are because the ADX is moving up, but it's right at 20. There is separation between the two directional indicators, but if you've been listening for any length of time, you know I talk about how when the ADX comes down, first of all, I like it to drop below 20 before setting up again, which it did do. And now it's broken back up above the negative directional indicator, but we're right at 20. And I've seen this come here just like we did right through here and then roll over. We did manage to, and that really shows you the complexity of the move that has occurred. It never was really strong, as evidenced by the DMI at least, but it moved higher nonetheless. And so could we do that again? Could we kind of roll over and keep this little snaking motion that we're going with the ADX? That would imply that we're going to find some resistance here. I think that the short-term move in the markets is going to be news driven. It's going to be every headline coming out of Washington on where we are with this bill. But don't forget that in this bill is the increase of the debt ceiling, which if the bill fails in the House and we have to drag this out a bit longer, we could see some concern about the debt ceiling once again, in addition to whether or not the bill can get passed. And so let's look at the CCI, and you can see it got to, let me go ahead and take the DMI off so we have a little more room here on the CCI. And we got to an extreme point high, and then we've rolled over a bit, but we were pretty high for the short-term move. So that last C wave extension, that was really this C segment here, right through there. I know it's really confusing to look at all these lines on here. I'll take them off in the near future and then we'll start over. But from here, That was a pretty straight up move. And that was evidenced by that CCI. And now maybe we need to take a pause. So the CCI on the short term is suggesting that maybe the market does rest here for a few days. Maybe we rest throughout the rest of this holiday shortened week until we find out what's going to happen with that bill. So all those things can be in the back of your mind and should be affecting trading decisions. But you trade the best of the best, and we look for where are things showing us that they are strong moves and could continue, and that's where we want to be. So, a lot of commentary to make on the chart of the S&P right now, and just it's an Elliott Wave clinic. I believe if Mr. Elliott was here, he would be loving this. If everybody, not everybody, but a lot of people ask, about zigzags, there's a common misconception that it's a corrective pattern. It's labeled as corrective because it's one of the three patterns that normally occurs when a wave five ends, just like it did back here when the wave five ended in February. That was a corrective zigzag pattern, but that's labeled corrective like flats and triangles also are because those are the three patterns that usually occur once a wave five ends. You rarely go from one impulse five wave pattern to another. There's always exceptions to the rule. You can go back and look at charts, and every now and then you'll find one, but that doesn't normally happen. Usually you go through one of the corrective phases. So we did the zigzag. But even though it's labeled as corrective because it occurred after the wave five impulse ended, clearly a zigzag is a directional pattern. It's a three segment pattern versus five, like the regular impulse pattern, but it did exactly what it was supposed to do. And then once that ends, you're supposed to retrace the C wave, which we did back here on the gap up in early to mid May. And we came back down, didn't quite fill the gap, but tested that B level there of the downward zigzag. It held, and then we've been marching up since then. So a zigzag clinic, and zigzags were Ralph Nelson Elliott's absolute favorite pattern if you read his works. So that's really my synopsis on where we are there. I just couldn't be happier with the performance of um, the zigzags within the moves since February. Let's go ahead and look at the dollar real quick, and then I'll come back. We'll look at the VIX. I've been mentioning, some of you have been joking because I tend to repeat myself, but when I repeat myself, I'm stating things that I feel like need to be ingrained in your mind when you're thinking about your trading decisions. And I talked about the fact that we didn't want to lose the dollar. I don't want to see the dollar go down here to this wave five low. It's on its way. And my comments were initially, and it was just talked about on CNBC this morning, that this is viewed as good with companies that have international exposure for the exchange rate. So getting a little bit of a lower dollar is going to be welcomed by a lot of companies. But if we continue down towards this wave five tap box, we're going to get to a point, in my opinion, may not happen, but in my opinion, we're going to get to a point if the dollar continues down like this that we start to be concerned about it. That is the dollar, the currency of last resort, et cetera. And that will bring a different viewpoint to the equities markets. But we're in that phase right now, breaking the 97.5 level where it is viewed as a good thing. I just thought it was interesting that those comments were actually made on CNBC this morning. All right, so let's go back, take a quick look at the VIX. Where do we go on the VIX? We are trading down here below 17 and a half. And do we march down towards 15? I would say normally that would be likely in a holiday shortened week in the summertime. So let's also remember that things tend to be less volatile in the summer. A lot of people take vacations. There's not as many traders around, et cetera. That's why normally the summertime they call them the summer doldrums from the markets because it's a low volatility time. And we have a holiday week, holiday shortened week in the summer. So that's normally a really low volatile time, especially with July 4th being on a Friday. So people not only take a long weekend, but they take the whole week off. And if it wasn't for this bill floating around and the potential short-term news headlines that could come out of it, I would say we're likely to head down to 15 by the end of this week. But any sort of a negative headline from any member of the House stating that there's no way it has the votes to pass, etc. Any comments along those lines, especially when you have a lower volume like you do in a holiday week, in a lower volatility time like we are in a holiday week in the summer, then you could get exaggerated volatility. So if it didn't have that, if this was just no news events with the bill, et cetera, I would think that we would likely drop down to 15, and then we'll have to look to see does it hold like it did back at the beginning of the year. You can see where 15 held on the VIX for the first 3 months of the year, 2.5 months. Does it continue to do that, or do we bounce back to the upside or bounce down to 12 and a half, which would take us all the way back to where we held last summer at this time? Pretty good evidence right there of what I was talking about as far as the summer doldrums, low volatility. It was exaggerated last year during the summertime where the VIX just hugged that 12 and a half line before all the craziness started prior to the election. So we'll keep an eye on the VIX and see how that transpires throughout the week. But again, hard to make a decision there. I think it's just going to depend on news coming out of Washington is where we go from there. Taking a look at the DIA, and I posed this question to you, and I've posed it to pretty much everybody in any of these live events that I've done. Where would you rather be? Would you rather be trading the Dow that held support at 420, also broke out and came back and tested the triangle right at 420, and oh, by the way, tested the 50-day moving average also at 420? So we had a very logical point here where the Dow could start to move higher, and it's playing catch up. It's not at its February highs yet. The S&P's broken them. And so now we're getting all the headlines of the market at all new all-time highs. And we're in a kind of a rare situation monetarily right now where normally the institutional traders suck in the retail traders because they have the big money. But there's $3 trillion in money market accounts right now. So the retail trader is wielding a powerful wand right now, if you will. And it could be interesting to see if the retail traders actually bring some of the institutions back in if they continue to push things higher. There are a lot of retail traders that are bearish, however, as evidenced by the amount of money that's in money markets. So we'll have to watch that money flow and how things move there. Does that money come in to the markets now because we have all the headlines of new highs? Anyway, got off topic here, but we're a little bit above the 10-day moving average on the Dow. Maybe that needs to calm down a little bit, but I was comparing that chart where we would be running up towards the February highs, and again, playing catch up to the S&P and the Qs, which have taken things a step further. They've broken their February highs. So the question that I asked was, would you rather be trading the DIA, representing the Dow, playing catch up to the February highs, or would you rather trade the Qs if they break their February highs? Well, we're there. They broke the February highs. So we broke them. We've come back down. Got a little bit overbought with a doji there yesterday, just giving a little bit back today, but nothing to be concerned about. Still well above the 10-day moving average. And perhaps we come back down, test the 10-day moving average, and test that wave 5 high from February. It was resistance. You know how it works. What was resistance? Is it now new support? You have to test it to find that out. And perhaps that's what the Qs are going through right now. We broke the level, and maybe they're going to come down and test it and see if that level does indeed hold as a support level now. So the question was, would you rather trade the Dow playing catch up that has a lot of clean air, or the Qs that are breaking the new highs and have a lot of clean air? It's an interesting question. And what I talked about yesterday to our EWO Trader Live folks was maybe you do both. Maybe you just kind of allocate some capital to both markets and then let them fight it out. Why do we need to pick one? Type of thing. It was just an interesting question. And then the IWM, which had a pretty nice little breakout from its triangle back here around the 200 level. It was a little bit above that, more like 205. We broke out, tested it, and we're trying to move higher here. And look where we got 220, where I thought we would go on the IWM. So now that we're here at this 220 level, what happens from here? Do we fall back a little bit or do we power higher to 230? And I've been on the record stating that I think if we break 220 with a little follow through, we probably reach 230 in relatively short order. And this is showing some faith in where the economy is. As you know, the small caps are number one, rate sensitive, and number two, an indication of the risk tolerance of traders. So it's a good risk on, risk off type indicator. So now we're at 220. Does the IWM rest or do we turn and go higher? But we did hit our target that we had talked about here as a case study idea on TradeFinder. We're there. We closed it out on the TradeFinder page, but we nonetheless did hit the target that we thought about. Now let's go to the bond market. So let's see what's going to happen here. So far, so good. We are staying in this old-fashioned upward trend channel where you just draw a line connecting the higher highs and higher lows. We did have a bullish 1030 cross. The C wave extension ended on this zigzag pattern, right at the 100% extension, and then drove a little bit lower, and it also hit the 138.2% extension. So isn't that interesting that we've had two zigzags, the downward one on the SPY that had a 38.2% B wave correction, and then on the TLT, which is prices on the 20-year, both go to their 138.2% extensions. So maybe we're going to start doing that a little more often. Maybe we need to keep an eye on that. But when a zigzag ends, you normally retrace the C wave. And if that continues, then you retrace the entire zigzag move. Well, this is where we are on the 20-year. We have retraced the C wave. We're right back to the B wave. So we've done exactly what should happen here. And that's been constructive for the markets as well, as bond prices are going up, yields and rates are going down. That's helpful. That's been helpful to the IWM. But where do we go from here on TLT? We're right in the middle of this trend channel. Do we continue up in this move? Just nice bleed up to the upside here, all the way to retracing the entire zigzag. At this point in time, anything can happen on the TLT. So we've accomplished the rule, the zigzag rules of the C wave retracement, and now it has to tell us what it's going to do. So these are points where you don't pick anything, pick a direction, you let it tell you where's the next impulsive move going to be. And then the TNX, I know you guys like the TNX a lot. I say that because every time I show the TLT, you ask about the TNX. It's going to be the opposite, which it is, because this is yields, the rates on the 10-year. So if the prices on the 20-year are going up, indicating yields and rates are going down, you can see it evidenced here as rates on the 10-year are also dropping. So a little bit of a move down in rates on the 10-year, move down in rates on the 20-year. They're kind of in concert. The yield curve is not very steep. It's still rather shallow, but at least it's not inverted at this point in time, which is a good thing. But it's perilously close. Things could reverse with some sort of a news headline out of nowhere, re-escalation of the war between Israel and Iran, China, Taiwan stuff coming back. Anything could happen to upset the bond market, but for now it's cooperating rather nicely. Let's take a look at the metals because gold is getting a renewed bid today, right back up into that triangle. Can you imagine that? This is a huge triangle here on GLD, which I've talked about a lot. It loves to consolidate and break out, consolidate and break out. Well, we could have drawn a triangle a couple different times here, and yet it just said, no, we're just building a much bigger triangle. And what normally happens when you go through a phase like this in a triangle, when it extends and builds a larger one, is the breakout becomes more volatile. So you tend not to get that just little 45-degree angle breakout move. It tends to break off and run when it breaks out of one of these triangles that has gone through an extended consolidation period. I'd like to look at the ADX here to see if it's diving down, and it is. Look how low that ADX is. So we are going to get some sort of a big move out of GLD. Which way is it going to be? You don't pick a direction out of these triangles. Just know that it's going to be pretty substantial. The bottom is 290. The top, I'm in rounding up here, 30 points is going to be the move on GLD from this triangle when it decides. So we'll let it tell us. Silver, um, kind of just hanging around here. It did go through a little bit of a catch-up phase here, and this is where you can see the lower signals on the AI signals. We had a 71% signal here on SLV, still below the 75% threshold, but I personally like signals 70 and above. I think they work just as well as the 75% signals do. And it was spot on. Look at this AI target right here. And then we had a vertical breakup, two sideways days, and another vertical breakup. And we've just been going sideways for the rest of the month here, exactly where the AI target said. So AI-ifying zigzags and breakouts and all this stuff is just an amazing help to your trading. Now we need to find out, does SLV continue its catch up? Well, maybe SLV is waiting to see which direction GLD breaks from its triangle, because we really don't have a triangle here on the SLV. And when GLD breaks, we'll find out if SLV is still in quote catch up mode. Looking at the crypto space, every time it looks like the cryptos are ready to move, they fall back, fade and fall back, or fire and fall back. They've been doing both. So over here, fire, fall back, fire, fall back. Here, fade, fall back. So we're just continuing in this consolidation area, primarily, but not exclusively, focused in this tight area here between 57 and a half and 60. So we can extend these lines out. And then you look at that triangle, and we broke down almost exactly the amount that we were forecast to. You measure the width of the triangle, and then you take that level from the point of the triangle, and that's how far you're expected to go. And that's pretty much exactly what we did. And now we're right back up because triangle rules, just like zigzags have the rules, so do triangles. Where a zigzag retraces a C wave, a triangle goes back to the point of the breakout. And that's where we are. And we're in this tight channel. So no real definitive directional bias here from the pattern on Bitcoin. And then looking at Ethereum, pretty much doing the same thing here. Its trend channel here is more 17 to 20 is its little bit of a triangle range here. It did the same thing. It didn't quite fire as hard as Bitcoin did. It's been lagging, as you know. We did have this one little run up here where it went through one sort of a catch-up phase and then just kind of stopped. And we've been going dead sideways since then. We had the one fade day, but no follow through day, right back up here above the 50-day moving average. So we broke it for one day and we were in danger land of giving all of this vertical move back, but we didn't get the follow through day and we're back hugging that 50-day moving average on Ethereum. If you're long Ethereum, you desperately want it back above 17 and a half, and then let's try to run up to 20. And can we hold this level, at least as evidenced by the ETHW right now? Will be interesting to see as we go to energy. Last week, we just did a a bit of a post rather than an idea. Felt like maybe we were going to get an oversold bounce here on UNG, and we did for one day. We got a retracement intraday on one day, a gap up the next day, and now we're right back down here again, trying to see if we can hold 15. So we're right in this area of where the wave three low was. Since we went down far enough, we actually labeled the five, or the software did. I don't label these patterns. People ask that a lot as well. The software does it as programmed by the algorithm that Ralph Nelson Elliott wrote. No personal adaptations. And we're in this wave five tap box now. So how far down can UNG go? It could stop any time now because it has pierced the tap box, the target price, or it could continue down towards the bottom of it. It could go lower. So we're in an area here that's very difficult to figure out where natural gas was going to be. I actually thought the bounce might last a little longer than that, a day and a half, basically, to be specific. But that was it. That was all the bounce that we got. And now we're back down. All right, let's take a look at oil, which I'm sure in the summertime everybody's interested in, and it's acting just as we thought it would now. We did get the outsized move here based on that Israel-Iran war conflict, but once it appeared that there was no targeting of oil facilities, etc., Iran didn't block the straits, those things that were concerning the oil market that gave us this pretty vertical move up, just gave us the rules we talk about. If you go vertically up, oftentimes you come vertically back down. Get too far from the 10-day moving average, you're going to come back down to the 10-day moving average. So we accomplished both those rules on this move on USO, and now we're back within the confines of this big trading range that I've been saying for a very long time, and I still believe it is where we're going to spend the majority of the year here. So far, that's worked out pretty well, aside from a test of the lows in April and call it a test of the highs there that we had in June. But for now, I think it's calmed down. And part of the reason is I don't think OPEC or OPEC Plus wants oil prices to go too high. They don't want to push people into electric vehicles because gas prices are so high. But they like having oil at slightly elevated levels so that they can make more money on the amount of oil they still have left in the ground. All right, with that, that covers off the markets. I'm going to go through internationally real quick, and then we'll open it up for questions. And then Zach will be back to do our trade idea for this holiday shortened week. There's the EWA. We broke above 26. I thought we'd go to 27. We didn't make it. We came back down, tested the 50-day moving average first, but now we're back in the same spot. We're back above 26. We're back above the 10-day moving average. So I'm back in the same thing, back in the same mode of thinking that the EWA needs to test 27. And then we'll have to find out where we go from there. No five-wave pattern associated in this. So could you label a zigzag here? I don't know if that's enough of a corrective move, but let's try it. And not really. It was just a 20% corrective move, so that doesn't really count. So we'll take that off. Just call it the 23.6% fib level, which even Elliott didn't really like. So we'll see if we can continue to move up from there. And the one market that I felt like needs to come back to reality, the Canadian market, at least as evidenced by the EWC, has just ignored other than just an initial move lower when all the tariffs were announced, immediately rebounded and seems to be not really worried about them at all, and continuing to move back to the upside here and just beautifully trending its 10-day moving average. That's why we talk about the rule. No security in any time frame gets too far from the 10-day moving average, because when a stock is trending, this is what it tends to do. That's what the 10-day moving average is designed for. And so you couldn't have asked for a smoother move here. At some point in time, though, because we did make a new high today, that wave three moved over because we made a new high. I do think that we need to rest here on the market in Canada. And you can see, as evidenced by the ADX coming down, that even as we move higher, the move is getting weaker and weaker. And as I've talked about this, when the ADX remains above 40, it does not mean the entire move is over. It simply means the strongest part of the move is over. And when you get to the point where the strongest part of the move is over, it makes you susceptible to that wave 4 correction at some point in time. Take a look at the German market real quick. Another one that really needed to come back to earth. And now that the ECB seems to be pausing a bit on their aggressive rate cuts, we'll see if the EWG can break this wave 5 high, or if we're setting ourselves up for a lower high here and perhaps the beginning of its corrective move post wave 5 completion, because you can see at an extended move 120%, we're right in the tap box. That could play out. Taking a look at the market in India, it's gotten a little bit of a boost here back to the upside in this wave 5 pattern. How far can it go? Got a little bit overbought at the end of last week, back to the 10-day moving average, testing the wave 3 high, and seems like the Nifty wants to move back up into this wave 5 tap box, but it's not that far away. So don't get too excited. Another nice trend channel that we've just been following here, plain old uptrend, lower volatility type movement. But when we get to that level, then we'll have to see how much strength is left in the move on the Nifty. And then I do like to bring in China because they're in the news a lot. The U.S. and China seem to be playing nicer and intent on working something out. Supposedly, there's 20 plus agreements that are going to be announced soon. And I would think China's one of those. And if not, then that July 9th date looms of when the tariffs are supposed to go back into effect. The 90-day pause ends. But nobody thinks that's going to happen in the administration. They feel like a lot of deals will be announced, and we'll see what they are. Chairman Powell came out this morning and talked about a war of words. Just to deviate for a second, you know that President Trump has been kind of calling Chairman Powell names because he's waited too long. Well, today he said the Fed would have cut by now if it wasn't for tariffs, because they're still concerned about any inflationary pressures that could come from the tariffs. So, that's his shot back, I think, putting it back on Trump, saying you're mad at us for not cutting rates. Well, if you hadn't done all this tariff stuff, then we would have cut by now. But that doesn't solve the unfair trade practices that have gone on between the U.S. and other countries taking advantage of us because we are the consumption engine for a long time, just trying to balance it out a little bit. Well, let's see if FXI continues up in this C wave. We're holding the average at this point in time. And if we do hold, we should go up and test those March highs on the FXI. So far, so good there. All right, Zach, I'll go ahead and open it up to questions before we come back and take a look at trade idea for today.
Sounds great. Let's get right into it. Got a question here from Bruce on SMCI.
Yep, I am a fan of SMCI. I mentioned that yesterday during our Evo Trader live session. I mentioned that we might have a little resistance right there because that's the resistance line I drew at 50. We got there yesterday, turned back a little bit, kind of ho-hum day today. We have a heck of a storm right now. So if I lose you or have some internet issues, just wanted to let you know ahead of time. So holding the 10-day moving average on the low, we rebounded from that. But right now we're just in holding mode on SMCI. I still feel the same way. If you're long this stock, I'd stay long as we stay above 45. Then you would have to be willing to accept a little discomfort down to 40, which is the next level of support and where the 50-day moving average is. I think that would likely hold. That would be an ideal entry. I don't know if we go back there, but if you're long and we come down there and you've held, you could add at that point in time. Be very surprised to see us break that 50-day moving average. Super Micro does make a lot of money, and they just went through all their accounting issues. So rightly so, the market beat them up. Those are not good headlines to have. But if they've got that straightened out, which they claim they have, and we just get back to business, then we should see SMCI move a little higher. If you're waiting for an entry, just as I said yesterday, wait for that break above 50.
Alrighty, let's head over to take two, TTWO.
I haven't looked at that one in a while. Zach, I believe you, when you were in younger days, kind of used to talk about these kind of games. I think you probably helped them along in their process to the upside. Um, I don't know all the video games. I don't know exactly um, which ones that are being used, but I know Take Two is in the mix of it. Very nice Wave 5 move to the upside here, getting up towards the 240 level. And that is extreme because it was resistance back in May, beginning in middle of May. We got there as resistance again in June, broke above it, and we're testing that now. So the question remains, is the end of the wave 5 at this resistance area, and we need to start pulling back, or can we extend the wave 5? So you need to watch and see how Take Two handles 240. Can we put a little bit of distance between the price in 240? And the first thing I'll look at will be taking out this wave 5 high that occurred last week. If we can do that, I think there's another leg to run on Take Two. But you have to, you're in an area where that could be the end of it. The ADX is suggesting that there's gaining strength, but it's not to 20 yet. Now, if you can get this ADX to set up, and I'll just extend that line over from the last time we talked about it. If you can get that ADX to break above 20 and these two directional indicators to separate, you could have one heck of a run on it as it just sets up into the strongest part of its viewpoint, if you will, from the DMI. But we're not there. So for now, again, it's kind of on hold and see how it handles 240. You do have to keep in the back of your mind that there's a potential that wave 5 is over if the ADX cannot break it above 20. If the ADX can get above 20, I think that suggests that we have a new leg to go. That's what I would, the determination there on Take Two.
Thanks, Rob. Excuse me, a couple of symbols here from Alexandru. First one's going to be GOOG.
The GOOG. As you know, one of my favorite stocks to trade over the years. More Elliott Wave trades on this stock than any other single stock. It tends to just follow to a T Elliott Wave patterns. We'll see if it does it again. We had the zigzag continued back up. Now we're testing this wave 4 high. That Elliott wave pattern is disqualified, so that's not a concern. The only question is, can we break above this level that we hit in yesterday's trade right here, just above the A wave? So these are all levels that are testing that A wave high. If we can take above, trade above this, and notice neither one of the follow through. That's why the rules come from. Above 180 with.
Yeah, apologies, everyone. It seems that weather is affecting Rob. Let's see if we can get him back in here. So just hang tight with us for a moment.
Sorry, my back.
You're back now. Yep.
All
We
right.
lost you.
I
See
did
if you.
warn you.
Yep, you called it.
Warned you. Yeah, it is
Uh,
a nasty storm outside, and that was one heck of a lightning bolt. I'm glad it didn't take out the Starlink. So, yeah. But it definitely affected it for a few moments. What was the last thing you heard, Zach?
you froze up and only got bits and pieces in, and then fully dropped. So I would,
In Google?
yeah, I would say maybe a quarter into Google.
Okay. Did you hear my soapbox about the rules? I don't want to go through that again if everybody heard it. Um, I'll go back to it. I was talking about follow through days. So, and why I talk about these rules so incessantly. I mentioned that a lot of you hear them week in and week out, and you're probably tired of it because you know them by now, but we add new people all the time. So that's why I keep repeating them. But a follow through a confirmation day is important when you're doing something like trying to take out the A wave impulse high. So we tried it here in June, no follow through day, came back down, reset ourselves at the B wave, moved back up, and tried it again. Again, no follow through day today. So what we need is for Google to break above 180 with a follow through day. And what I was saying is if that happened, I think we go to the 100% extension. And if we're going to get that close, I can't imagine that we stop at 200. Okay, knocked off the screen too. So thanks, Zach. There is the chart. So just real quickly, there was no follow through day there, no follow through day here. If we can get above 180, I think we go to the 100% extension, and that's so close to 200, it would be difficult for me to imagine Google to get that high and not go to 200. But first things first, we have to break above 180 with a follow through day because this is what happens when you don't. All right, done with Google now.
Okay, I got worried there a second. I didn't know if you were dropped out again or if that was it.
Yeah, I figured
BX,
I better say something, or you might wonder that. I'm sorry, what was the next one?
no worries. BX,
B is in boy, X.
that's correct.
Okay. Blackstone is private equity, and that's a pretty good area where people have been. You may have seen or heard the headlines that there aren't as many new IPOs coming to market as normal. And that's because there's been a lot of private equity involved. And Blackstone is one of the big ones. And I think that they're one to watch. But at this level, it's very similar to what we just looked at with Google. There was resistance there back in March, again in May, and here we are again. And we're a little above the 10-day moving average. So this is actually the kind of price action you want. You want it to consolidate under a resistance level and allow the 10-day moving average to catch up. Because when you break above resistance and you're already overbought, it tends not to hold. You have a much better chance of it holding if you consolidate under this level and then break higher. And so that's what we'll look for here on Blackstone. If you're long, no reason to get out. If you're looking for an entry, let it break above this 153 area here. And then you're going to have a quick move, a quick 10-point move, I would think, because there's nothing to stop it. We came down rather quickly on the way down back in February, and I think we would return back up to that level. So again, if I was long, I wouldn't get out, but if I was looking for an entry, I'd wait just a little bit.
Quick conceptual question from you for you from Huey. Can you clarify a bit on that ABC and then mark at wave three? Should it be account already as one, two, three as part of impulsive wave by now?
On, are we talking about this one? What stock was he
No,
referring to?
that's going back earlier in the presentation. So perhaps it might have been on the SPY or dollar. There was no
We did go through all of those. Well, that's going way back. We did go through all those rules in that Zig-Zag Masterclass. That's why we did 4 sessions on that to cover each and every one of these rules. And that C wave has to extend 161.8 of 1 before the 3 will label. So you can be in a zigzag, and that's what it takes for the algorithm to actually label it as a 1, 2, 3. That's why all wave three or all five wave patterns start with a zigzag, but not all zigzags turn into a five wave pattern because you have to have that C wave extension target first. So that's the rules.
Very well, yeah, and good reference to that. Zigzag Mastery. Definitely check that out for a further in-depth analysis. Lots of insightful content in those courses. Let's head over to AR real quick.
If you didn't watch the Zig-Zag Masterclass and you're not interested in them now, after what I showed you at the beginning on the chart of the SPY, I have no idea what to say to create interest. You just anti zigzags because that is a masterclass in itself. AR, yeah, we looked at this one and it's not having a very good day today. And you can see that we are in danger of taking this one off. Once again, it was a 72% target, which is not 75. It's not green. So the way the AI works is if that number is 75 or above, that little end of the pill-shaped thing turns green. The fact that it's gray is it's in a gray area. It still looks good, but it's not quite high enough. Well, I liked it, and so moved forward anyway, as evidenced by the confirming indicators. But we really wanted it to continue to hold here. Yesterday was a little concerning. Today's far more concerning. And now we're coming down and touching this fail zone area. But we have this B wave here that we could still hold and turn and go back. So we're right in an area that if it doesn't hold here, then you just have to bail and get out, take the loss and move. But we're going to give it a little bit more time, and we are oversold based on the low today from the 10-day moving average. So we should at least get a short-term bounce back up, but it's got to hold right here. Otherwise, it will be one that doesn't work, and then you move on. Now, the beauty of Elliott Wave is that if you do have a failed pattern, and notice the zigzag did not fail. The zigzag worked perfectly. We had a 38.2% B wave correction right to the 61.8% level. That's what it's supposed to do. That could act as resistance, which it did. Maybe we get an extended target. And if we did, that would actually move us past the AI target. So far, that hasn't happened. It's not over yet, but it could. My point that I was going to make is one of the beauties of Elliott Wave is when a pattern does fail, if this one fails, and it's dangerously close to that, not there yet, but if it does fail, then we're likely coming all the way back down here and we're going to retrace the entire zigzag. So we've already retraced the C wave. And if we break that, that means we're retracing the entire pattern and we're going to come all the way down to the tariff tantrum lows. So you just flip the script and go the other way, and you turn a losing trade into the next trade being a winner. And if that does happen, so another thing, I was asked yesterday, I guess, about why, again, I'm such a fan of the Elliott Wave relabeling. First of all, it's very responsive to the changes in the market. And secondly, based on Elliott Wave rules, if a pattern relabels, the new pattern has a higher percentage chance of occurring than the previous one did. How many indicators do that when they failed, you're not just scrambling to try to salvage something, you actually have a better signal than you had initially. So that's why I do a lot of adjustments.
Thanks, Rob. Excuse me. Let's check out Disney real quick. DIS.
Yeah, I'm glad you asked about that one. Being originally from Central Florida, obviously, I have the honor of when I was young. My parents took me to Walt Disney World the very first week they opened. How about that? How many people can say that? Not many. But I'm young enough to remember going across a wooden causeway to get there. But nice breakout. You have to like this pattern. And they were talking Disney up quite a bit on the financial networks yesterday. The theme parks are doing well. They're really getting their act together on the streaming service. The new CEO has really got them on track. But you like the move. The fact that we had this vertical move and we didn't give anything back. We consolidated sideways. That's unusual. It held at this support area from February and March. And then we ran up, tested the highs from February, consolidated again. And now we're off and running again. The problem is this move is getting a little vertical. We're a little away from the 10-day moving average, which is why we're pulling back now. I think you stay long Disney as long as it stays above 120. If we give back 120, I think you got to get out, especially with the nice run that it's had. I mean, almost doubled off of the tariff tantrum lows. That's a heck of a move. So you got to not be greedy at this point. But you want to get as much as you can out of it. And so I would watch. This gives me an opportunity to show this unusual ADX. This happens sometimes where it goes sideways. And when it does that, see, this is kind of a nice thing to end on, Zach, and then we're going to go to the case study for this week. But you can see this sideways movement here where we were consolidating. And remember, I just mentioned that that's unusual, and that was a good sign of strength. Well, look at what the ADX was doing during that time. It was going sideways to slightly up. It was telling you it's holding strength. That's what that meant. So that sideways consolidation move without the ADX diving back down, which it often does during a consolidation phase, even drifting a tiny bit higher, was telling you that that move was consolidating and holding strength. So it gave you kind of an early indication that we're likely going to move up again. And it did. And now we're doing it once again, albeit at even more elevated levels. But perhaps we hold 120 and take off on another leg. But the further up we go on the ADX, the closer we're going to be getting to when it's finally over. But if I was long Disney right now, I would not be worried about what's going on today. I'd be holding it and I'd stay long as it can hold in this 120 range. If it breaks that again, I think that's your exit. That's your stop. But for now, let's see how far it can go.
Very well. All right. So as you mentioned, we'll head over to the platform with coming up at time here and post the case study consideration for this week. So I'll go ahead and take over the screen here. And if you want to just go ahead and step me through this week's case study consideration, I'll show everyone how to post it.
Yeah, we're going to do a post again this week. Would have looked at something else, but the sector isn't performing so well today. So we're going to look at Apple. So it's just going to be a post, not an official idea. So you can walk the folks through what that means. If you acted really quick, you did well on the one last week, but man, you only had a day and a half to take that gain, or you actually 1 day to take it. You had a 1.5 day move. I didn't think the bounce would be that short, but I do feel like Apple is going to play catch here. And since it doesn't follow all the rules, anyway, you explain it, Zach. I don't want to take
No worries at all. That'll be further elaborated on in the post as well. And so as we can see over here on the left toolbar, there's the new idea light bulb, and we have the idea for an official idea when that criteria is fulfilled, or the post option for what we're going to do today, which is a bit more around a discussion post. And as Rob was beginning to eloquently describe here, we will continue that context here in the post itself. And as always, we welcome your opinion, whether you agree or disagree. We'd love to hear your thoughts and evidence around it. Opposing opinions is what makes markets. If everyone agreed, there'd be no trades to take advantage of. So like I said, wouldn't dare try to take over Rob's analysis there. As soon as this session's over, we'll make sure to come through and add all of the context that Rob was just describing. But it'll be posted and available here shortly for you to interact with. So I'll pass back over to you, Rob, if you want to take the screen back and wrap up your final thoughts for this holiday week.
Happy to do that. And again, thanks for sharing some of your trading day with us. there's the chart of Apple, and you can see that we are getting some confirmation on the breakout of this triangle with Apple, and they've got some news. Now, there's been arguments on the financial networks today back and forth on whether or not this changes things for Apple. The pure Mac heads are not really happy, but basically what Apple said was they do want to have AI powering Siri, and they're not opposed to going out to OpenAI or some other source to gain their AI technology, but that at least it shows they are where they failed miserably in their last conference to inspire anyone that they are moving towards AI. But this is viewed as a positive, and the pure Mac heads are like, develop your own. Why don't you develop your own AI? That's what they're upset about. Why would you go outside? Well, Apple has tended to spend money buying things rather than innovating things over the last years since Steve Jobs died. So I want to get on that soapbox. But the bottom line is the reason that this is just a post is we have some resistance here at 210 that we got to get above first. But we are breaking out of this triangle, and we'll see if we can break that 210 level. If we can, I think Apple goes to 220 rather quickly. So that'll be our target, Zach, will be 220 on it. It may need a day or two to consolidate underneath 210, but if it can break it, I think 220 happens rather quickly. So that's post thought, as Zach so eloquently commented. We will be doing the U.S. market update this weekend, so keep an eye out for that. That'll wrap things up for the end of the week. But we will have a muted broadcasting schedule between now and then with the holidays coming up, travel plans, etc. So with that, thank you again for spending some of your trading day with us. Hope everybody has a great Fourth, a wonderful holiday weekend. If I don't talk to you again beforehand, but as I said, we will get that U.S. market update out this weekend as well. So